In today's video, I'll be going over 3 great dividend stocks. All 3 of these the last few weeks have been trending downwards and are nearing their 52-week low. So being at a discount, you may just want to consider picking up some of these shares or even adding them to your portfolio. I will be using the dividend tracker to go over some graphs when looking at their fundamentals. And if you are interested in joining Dividend Tracker, I have a referral link down in the description. Without further ado, let's jump in. First company on our list has a market cap of $292 billion and is in the consumer discretionary sector. This company is Home Depot, ticker symbol HD, and it is the world's largest home improvement company with more than 2,300 stores that hold over 30,000 products, and these stores are within United States, Canada, and Mexico. Since the beginning of the year, Home Depot has fallen over 9%, and within the last month, it has fallen 8.75%, which brings it to a current share price of $286.31. With this recent fall the last month, it is nearing its 52-week low, which was $264. It's trading at a PE of 18.04 and has a nice dividend yield of 2.96%, which will give you an annual payout of $8.36. Now, Home Depot has been buying back shares year over year, which you can see right here. As far as the revenue growth, we did get a bump up in 2020 and has been moving in an upward direction. As far as net margin, moving year over year with a little plateau the last couple of years, but still in the upward direction. And as far as earnings per share, has been moving in the upward direction as well. So that's great to see, and a nice spike up this last year. Looking at its dividends, Home Depot has been growing its dividend year over year, which is great to see. And their payout ratio is only 46%, so it still has some room to grow. Looking at its free cash flow, has been growing year over year. We do have a nice spike up the last 2 years post-COVID, and right now moving back towards its numbers prior to COVID. Now, talking about dividends, 2-point dividend percent, Home Depot pays about $7.8 billion, and looking at their free cash flow of this last year of $10.5 billion and their 5-year average of $12.3 billion, they can definitely afford paying that dividend amount. One other thing I want to point out is their return on invested capital, the ORIC. And this is important to look at because it's how well the company can invest their revenue and produce growth. So you definitely want to see a nice high percentage on this. And Home Depot does a very good job at reinvesting its capital. Looking at this last year of 46% and its 5-year average of 54%. So definitely great to see for Home Depot. And a company with the higher ROIC, you'll be willing to pay a bit more premium, higher share price versus a company that has a lower ROIC. Now, Wall Street analysts do consider Home Depot as a buy right now with a low of $264. Now, Wall Street analysts do consider Home Depot as a buy right now with a low share price of $264 and an average of $330. That will give you about a 15.5 upside. Over here, looking at some analyst estimations for the earnings per share, moving from 17 cents to about 23, so that'll be between 5-7% year over year. And looking at the graph here, you can see moving upward. As far as their projections for their revenue growth, also moving in the upward direction from 162 billion to about 183 billion. So revenue around that 2 and 4% range. As far as my analysis based on the historical values right over here, I'm using revenue of 3, 4, and 5%, profit margin of 6, 8, and 10%, free cash flow margin of 6, 7.5%, and 8%. As far as PE and free cash flow, I have 14, 16, and 18% with 10% return. And with these values, the current share price is right in the middle of my mid and high. So definitely looking for around the mid 200s as a good buy. And right now with the share price just coming down, I think it's a good time to add into portfolio and at least dollar cost averaging in if you already do have it in your portfolio. So underneath that 290, I think is a good price range to consider between that and 260. Over on a weekly chart, you can see the last couple weeks, Home Depot has been moving in a downward direction with a negative trend right here. And looking at the momentum, being below this white line, we are more in a bearish environment. And you can see here from the end of January, starting to have negative momentum. So we are meeting its 200-day moving average. Other lows were around that 260. So we are possibly moving to those lows, which are about a resistance points right now. On the daily chart, we are pretty much in the oversold and have a lot of negative momentum right here, just continue moving downward. After earnings, we fell right below its 200-day moving average and have been hovering between that 285 and 300 range, staying underneath all of its moving average. Next stock I'm going over has a market cap of $28.7 billion and is in the consumer staples sector. This company is Walgreens Boots Alliance, ticker symbol WBA. And Walgreens is one of the leading retail pharmacy stores with over 13,000 stores within the United States and internationally. From the start of the year, Walgreens has fallen 10.5%, and just within this last month, it has fallen 7.75%. Bringing it to a current share price of $33.26. Walgreens is very close to its 52-week low of $30 and is currently trading at a PE of 7.39. It has a very nice dividend yield of 5.77%, which will give you an annual pay of $1.92. Walgreens, the last couple of years, has been buying back shares, as you can see right here, and their revenue growth has been increasing in the last 2 years, pretty much stagnant since coming off of COVID. And looking at its net margin, in 2020 really did fall, but it's coming back up to the levels it had prior to COVID. And looking at its earnings, the same thing as net, come back to the levels it had prior to COVID. So that's a good sign for Walgreens. Dividend tracker does give them a dividend growth of 59. And looking at the dividend growth, it has been growing that dividend year over year, which is great to see. And their payout ratio is 42%. So they still have room to continue growing that dividend. And as far as their free cash flow, was increasing year over year with a slight fall coming into 2020. And right now it is still picking up its pieces coming off of that. So a bit lower this last year than previous years. Now with its 5.8% dividend yield, it pays $0.65 billion. And from this last year's free cash flow of $1.4 billion, it is over that range, but its 5-year average is $4.1 billion. So if Walgreens is able to get back to its previous levels, it'll be able to safely afford that dividend yield. Looking at its return on invested capital, it is in a negative percent, and its 5-year average 2.1%, and it's still kind of picking up its pieces coming off of COVID. With that, Wall Street analysts are considering Walgreens as a hold right now, with the average share price of $41, which will give you about a 25% upside. Now looking at analyst estimations, they're seeing the increase of their earnings per share, which this year it is negative percentage, but moving around that 5 to 7% going into the future. As far as revenue, they do see revenue as increasing 2% this year and increasing around that 5% moving forward. Now, based on my analysis, looking at the historic values right here, I have a revenue growth of 1%, 3%, and 5%. And for profit margin and free cash flow margin, I have 0.5%, 1.5%, and 2.5%. As far as PE and price to free cash flow, I have 6, 8, and 10% with 12% return. So with these assumptions and the current share price right in between my mid and high, I do see Walgreens as a buy right now, as it's getting closer to that $30 share price right there. Now over on a weekly chart, Walgreens is below all of its moving averages these last few weeks. We are in a negative trend coming off of the end of last year, and the momentum is on the bearish side. We were picking up some positive momentum here, but within the last few weeks, starting to get that negative momentum moving us downward again. Over on the daily chart, Walgreens is in the oversold section, and its momentum has moved down to the bearish side, right below all of its moving averages, continuing downward. Next stock on our list has a market cap of $151 billion and is in the communications sector. This company is Comcast, ticker symbol CMCSA. Now Comcast is a core cable and media company. On the cable side, it has broadband to residentials and businesses with its Xfinity brand. On the media side, it has NBC, Telemundo, and Peacock. And thirdly, it has theme parks with its Universal Studio brand. From the start of the year, Comcast has fallen just below 1%, and within the last month, it has fallen over 7%, bringing that to a current share price of $35.31. So Comcast is moving close to its 52-week low of $28 and is currently trading at a PE of 9.66. Has a nice dividend yield of 3.29%, which will give you an annual payout of $1.16. Comcast over the last few years has been buying back its shares, and its revenue has been increasing with a slight drop in 2020. Now Comcast has been pretty stable as far as net margin with a drop this last year, and that is the same for its earnings per share. and both of them has had a spike up in 2017. And that spike up is around the time that Comcast acquired DreamWorks. As far as dividend growth, Comcast has been growing its dividend year over year and has a payout ratio of 30%. So definitely have room for continuing that dividend growth. As far as its free cash flow, it has steadily been growing its free cash flow with a nice spike up this last year, and now we're coming back to the averages it had previously. And for the last 5 years, that dividend growth has been 7.8%, which is very nice to see. Looking at the dividend that they pay is about $4.7 billion. And within this last year, its free cash flow is $12.6 billion. And over the last 5 years, it's $13.7 billion. So they definitely can afford paying that dividend. Reinvestment on invested capital is around 7% this last year, and the average is 6.5%. So has a nice reinvestment in capital. Close to 10% is very nice, ideal for any company. Wall Street analysts do see Comcast as a buy right now with the low of $33 and an average of $43, giving you about a 23% upside. As far as analyst estimates, they do see their earnings per share increasing within the next few years and staying around that 8 to 10%. Now, as far as revenue, they do see it increasing within the next few years, but is at a slower increase than its earnings per share, as you see right here. We're in that 1-2% range. As far as my assumptions for Comcast based on these historic values right here, I have revenue growth of 2, 3, and 4%, profit margin of 4, 5.5, and 7%, free cash flow margin of 5, 7, and 9%, PE 12, 14, and 16, and the price of free cash flow as 10, 12, and 14 with a 10% return. So with these assumptions, I'm looking at high 20s as far as a good price to consider buying, and right now Comcast is moving towards that direction with the low 30s. So definitely, I think one you can start considering adding to your portfolio. Looking at a weekly chart here, Comcast is starting to turn into a negative trend right here. Its momentum is still on the bearish side, but moving in a positive direction. However, the last few weeks with that negative trend, it has been dropping and currently is underneath all of its moving averages. On the daily chart right here, Comcast is in the oversold section and the trend is moving towards the bearish side. Right here since the beginning of the year, it's just been in a downward direction and is now underneath all of its moving averages. If you enjoyed the content, let me know by smashing the like button. Helps grow the channel and also spreads the video to other investors such as yourself. If you're looking for more stock analysis, definitely check out this video right over here and I'll catch you over there. Have a blessed day. Peace.